23 seconds away from the opening bell in New York City this morning. Good morning to you all. We've gone over the losses over the previous 4 days. Down over the last 4 days by almost 6 full percentage points on the S&P. We're softer again. We're down 6 or 7 tenths of 1%. On the Nasdaq 100, we're down 9 tenths of 1%. On the Russell, the small caps, down almost 1 full percentage point. That's the equity market action. That's your opening bell. Switch at the board and get to the bond market. Yields higher. Jobless claims better. Claims a downside surprise. That's what you want to see. Maybe not what the Fed wants to see, and that's the problem right now. In the equity market, yields up 6 basis points in the bond market on a 10-year, 325 on 10s. On 2s, had a little look at 350 a little bit earlier on. A look at the dollar strength out there. Euro dollar, negative 7 tenths of 1%, 99.85, even with a long list of banks teeing up a 75 basis point rate hike next week on September 8th. Crude's lower by about 2 full percentage points, $87.72. 30 seconds in, that's the cross-asset price action. We're down about 6 tenths of 1% at the opening bell on the S&P. Let's get you some movers. We can do that with Katie. Hey, Katie.
Hey, John. Well, it's already shaping up to be a bad day for the chip sector after the U.S. limited sales to Russia and China, of course, on security fears. NVIDIA did say that could cost the company $400 million in sales in the second quarter. NVIDIA got limited licenses for AI chip exports to China, but still a bad day for the stock, already down 5%, bringing down the likes of Broadcom as well to about 2%. Keep an eye on Broadcom today because they report after the bell. Moving on, you had Campbell Soup reporting earnings this morning. Sales were actually 6% higher on higher prices. That turned out to be a wash, though, because expenses jumped 12%. That dragged down margins, dragging down the stock early this morning as well. And meanwhile, the job cuts continue. 3M coming out, cutting jobs to save cash amid high potential legal costs. This news, of course, hitting a day after we heard from Bed Bath & Beyond and Snap on their job cuts. But prices little changed right now, John.
Let's just clear this up. NVIDIA, not NVIDIA. NVIDIA?
NVIDIA? I don't know. That might be the New Jersey accent a little bit.
But I don't know. I'm trying to clean it up.
Sounds better when you say it. Sounds better.
I don't know if that's true, Katie. I'm not sure if anyone agrees with that. Katie, thank you. NVIDIA? Anyway, let's go with that. Just say it really quickly. Down about 5 or 6%. Abby's got more. Abby, which one is it?
I've always gone with NVIDIA, so I'm not sure if that's right.
But you and Katie win.
Okay, well, maybe, but I don't know. I agree with Katie. It might sound better when you say it. But in any case, any way you say it, the stock is down sharply, down about 5.7%, and this is just one slice of the weakness that we're seeing for chips right now. Now, of course, NVIDIA is down for 2 reasons today, a double whammy. Chengdu, as you've been talking about, has been shut down. That's 1.7% of the Chinese economy, and they received 26% of their revenue from China. So you have demand concerns. That's been a story for NVIDIA for some time now. They pre-announced in early August. They also put up a messy quarter. But then on top of it, what Katie was talking about in terms of the U.S. Requiring approval for some of their AI chips to be shipped to China on security fears around the military, that's $400 million worth of revenue potentially. Not a huge slice of the pie, but it's more the direction, the tension. And you have these chip stocks under so much pressure. Over the last 10 days, the stock's losing 10% of its value on the year, down much more sharply. And why this is so important, John, chips, of course, the stocks, it's a leading indicator. Chips are used in everything that we use today. So if you see a big slide here, it tends to lead the broader indexes. So really not a good sign potentially for the markets and the economy overall. And if we see more of a slide, because of course it's not just NVIDIA, Seagate, Flash Memory, they cut their third quarter by $400 million. Micron, that's NAND and DRAM, they see their third quarter coming in at the low end. And then Citi seeing, this is pretty bearish, 25% more downside for the stocks. And it's interesting because, as you know, John, yesterday, Jeremy Grantham said that that volatility that we've seen this year, it's just an appetizer to what could come. That matches that potential 25% slide on the stocks. It could just be brutal from an economic standpoint.
There's so much bearish stuff out there. I need a nice Marko Kolanovic note over at JP Morgan just to get my teeth into and talk about the bullish side of things for 5 minutes or so. Abby, thank you. Another slide here. 5 days of it now. 5 days of losses on the S&P 500, longest losing streak going back to, I think, July 14th. Over the last 5 days, down about 6.5% on the S&P, and now about halfway back to the June lows. From the highs of August, back to the June lows. Taylor Riggs, we're getting closer.
And I'm afraid that I'm not here to provide any of that positive sort of information, John, that you wanted, because take a look at this terminal chart, and we showed this yesterday. Sort of the big run up that we had off the lows of June, you were up 25%, and then of course all of that cut in half. Take a look at the last 2 weeks, you're now only up maybe 5, 6, 7% or so off those big bottoms that we had. It's interesting when you think about the last 2 weeks. Some of this is a micro story. We still did continue to get a lot of some of the quarterly results. Dollar Tree, Salesforce, Match, NVIDIA, as Abigail was talking about. So some of that was sort of this micro sort of individual story. Otherwise, it was some of those broad micro headwinds that we've continued to talk about. But those, of course, have been the stocks that have really been their hardest hit off of the peak that we had just about a few weeks ago. But don't ignore big tech, because that's also where a lot of the declines have been coming down to. Big tech is down about $1 trillion when you think about market cap, and it is the biggest of the big. It is a NASDAQ that continued yesterday sort of to be the big underperformer, and on an individual level as well. That shows it all.
There we go. Information technology down again today, and Taylor, thank you for that. We're down more than 1% on IT. Energy down about 2 percentage points. Crude a little bit softer, lighter, lower, negative on WTI again today. All securities on the S&P down about 0.75%. Got utilities firmer up by maybe 1/10 of 1%, call it 0.2 of 1%. That's where a bit of our performance is. It's a difficult moment. We're down about 5 days again. Down 5 days for the first time since the middle of July. Wall Street with one question. Where's the bottom?
The lead theme is that we end up retesting the June 16th low.
The market will be hard-pressed to really go too far below that at this point.
Our belief is that we do not set a lower low.
I think the lows are in.
We have about a 60% conviction that we saw the low back in June.
I wouldn't be surprised if equity markets go down a bit further from here.
That we're going to see a lot of volatility.
I've been looking for about 3,500, and the SPX is the rock bottom.
I think we will get through this okay.
There's a good chance that we could see 4,800.
I'm not for sure that I'm waiting for that second shoe to drop.
It will be a September to remember.
The market will bottom, and we think that's probably sometime between September and December.
Morgan Stanley's Dan Skelly joins us now. Dan, that was your buddy Mike Wilson. Just where is that June low?
Jonathan, good morning. So we think we're going to test that again in the next, call it 4 to 6 weeks. And I'll just say, with a nod to American football season coming back in the next month or so as the calendar turns to September, my coaches 25 years ago used to tell me to keep my head on a swivel. And I think that advice is incredibly relevant in the next month or so. You heard some themes from some of your some of the commentators earlier related to seasonality and liquidity. Let me just add 2 incremental comments that haven't been mentioned thus far, Jonathan. First, on seasonality, yes, September tends to be the worst month in general, but when you look at years in particular where the market was down leading up to September, the September average returns are actually even worse. And the second comment I'll make about liquidity, sure, we have the QT risk coming up, as everyone has talked about, but I think one development that hasn't been mentioned enough that Betsy Graysick at Morgan Stanley Banks Research has highlighted recently is that banks may also be de-risking balance sheets in the coming quarters to be more in line with Fed requirements on capital ratios. So that's going to add to the ambiguity in terms of liquidity.
So you think there's like a pro-cyclical type feel that the economy turns lower and these banks have to tighten up and it just kind of feeds on itself, Dan?
It feels like we're heading in that direction, Jonathan. In order to be more aligned with some of these requirements, you have risk to capital formation. You have some pressure possibly on credit here and lending. And look, that's on top of what is this kind of unknown, this known unknown emerging with the Fed's balance sheet shrinkage. So, Jonathan, that's not going to happen overnight. It's going to be a multi-quarter development, but it's something to keep an eye on. So to your earlier introduction, Mike was on a very lonely island earlier in January, and the island started to become pretty overcrowded in June. We had this massive rip higher, but we were cautioning people throughout the summer, unfortunately, that this was a bear market rally, and that's what it's looking to be.
Dan, dare I say there's no space left on that island. Everyone that comes on this program is almost bearish all the time. You're not a perma-bear, and I often remind people that you and Mike Wilson, in the depths of the pandemic in spring of 2020, were talking about a strong recovery in this market, and we got one. What would make you bullish again, Dan? What would make you leave that island, get on a boat, and leave everyone else behind?
Yeah, that certainly sounds fun, Jonathan, and I'll be sure to send you and the team a ticket as well on the boat. But what I would say is a number of things, right? First, we have to get some more capitulation in terms of the earnings picture lower, right? We've only seen 23 consensus sell-side earnings off 2%. And look, the reality is maybe some of the buy side is already there, but we expect those numbers to trend over the next quarter or two. So that's number one. We want to see a more reasonable and achievable level in earnings given this slowdown. The second thing I would say is, look, I think everyone is myopically obsessed with the Fed, whether it's 50 or 25, 50 or 75, et cetera. I think folks were too optimistic on a pivot coming earlier this year. Look, if we get a more dramatic economic pullback into the beginning of 23 and the Fed eventually does pause, that's a potential additional condition to get more optimistic. And then lastly, Jonathan, it has to do with the global picture. I think, look, given the news this morning, given updated lockdowns in major cities in China, given continued inflation pressures and commodities from the Ukraine-Russia stalemate, look, the global pressures maintain a huge overhang over risk assets. And so were we to see any relief politically in those fears, that could also be obviously an upside surprise.
Dan, a lot to unpack there, and let's start with earnings. Earnings is the big focus for you. You mentioned that a moment ago. Mike Wilson's been on top of that too. Earnings, in a way, have been flattered by what's happened with the energy industry. Energy earnings have been so tremendous. Where do you think the earnings risk actually lies? Where do you think that's going to be concentrated, that weakness that you're looking for? Where will it develop in the coming quarters?
A really excellent point, Jonathan, and that is actually absolutely true. If you X out energy, next 12-month estimates actually came down about 5%. So you're right, energy has really flattered the overall picture. In terms of the risk, we're very focused on idiosyncratic over-earners over the COVID pandemic period, right? So when you look at areas like metal, autos, semiconductors, these are some areas that had really unique benefits during that period, where we're actually seeing not only costs continue to be higher, some geopolitical issues on supply, but demand now, right? And some of these issues cyclically might come under pressure. So those are some of the issues, some of the areas, some of the subsectors that had benefited in the last several years that may be at more kind of particular risk from margin degradation going forward.
Dan, do you worry that you might be a little bit too early? Just looking at the jobless claims numbers we've seen earlier this morning at 232, do you worry that maybe actually this is a story for next year and not later this year?
I think it's a fair point, John. I would just say, look, in terms of your whole dialogue earlier this morning, in terms of bad news, whether it's good news or bad, and I think that the takeaway is, look, when you look at the trends just this morning, NASDAQ and high growth stocks are still leading lower. And that's because the read-through of the stronger job update was that the Fed is going to go 75, right? So the pressure on that high growth cohort reasserts itself. And so that's a big deal, right? Because as you know, and everyone has talked about, growth is such a big part of the U.S. index that it makes it much harder for that U.S. index to kind of fight its way higher. So as long as growth is still kind of leading in one of the troubled areas near term, it's going to be hard for the index to fight through that.
I think this morning's dialogue's been utterly depressing. The first message I got about getting on that bullish boat was whether it would sink, Dan, given all the bad news we've seen. Dan Skelly's going to stick with us. Coming up, the job cuts piling up in corporate America.
When I look at the payroll report coming out tomorrow for August, I would expect a significant slowing in the pace of job growth versus July.
3M, the latest firm to announce job cuts. That conversation up next.
I'd be comfortable with some weakness in labor markets if we start to see some job losses, but to be honest, we're far from that today.
We're going into this with an incredibly strong job market.
We won't be able to get the strong labor market conditions we had in the last expansion unless we get this inflation down.
We can't just rely on markets. We have to get our rate up to the level that will put downward pressure on inflation.
The employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting.
The data backs a lot of this up ahead of payrolls Friday. But looking at some of what corporate America is doing right now, you get a different picture. 3M, the latest, joining a growing list of companies cutting jobs and telling Bloomberg the following. The business can't avoid this tough necessity, adjusting to the challenging macroeconomic environment. And this means job cuts. Taylor Riggs has more. Hey, Taylor.
John, I'm curious if this is sort of trying to help us answer the question that you asked yesterday. How much of this is macro headwinds? How much of this is also a single company, maybe some of that execution risk, similar to what we were talking about yesterday with Bed Bath & Beyond, right? Because, yes, there are some macro slowdowns, but there's also been some big legal setbacks for this company. I think a judge last week had said on a preliminary basis they couldn't use bankruptcy to avoid what could be 230,000 lawsuits related to some of the defects within those earplugs. RBI analysts were saying those settlement offers could be $8 to $12 billion in total. So there is sort of that push-pull narrative of the macro headwinds and then some individual issues affecting this company as well. I think what matters for our investors is you take a look at what has been one of the worst years now going back since 2008. You're off about 30% or so. So this is a company that, yes, if we think about a bellwether for the economy, also struggling when it comes to the share price as well. Take a look, though, when it comes about job cuts, and I think what the economists are trying to sift through is you're getting some job cuts, but then you're getting jolts that are showing that there's still massive job openings. So what's the data that we look at? And the jobless claims, as Mike McKee knows better than anyone, shows that maybe things aren't so bad. So you tell me.
And we'll see in payrolls tomorrow. Taylor, thank you. 298 is the estimate tomorrow for payrolls. The previous number, as you know, just blew up every single narrative out there. 528K was the previous read. Mike McKee's going to break it down for you ahead of tomorrow. Hey, Mike.
John, let me expand on what Taylor was talking about here. You take a look at the unemployment rate, and it is still way below where it has been on average going into recessions. It should be about 4.7%. That's the average since the of the post-war years in terms of where unemployment is when recessions start. We are a long way below that. What is the Fed watching? Well, there are about 5,670,000 people who are unemployed right now. At 4.7% unemployment compared to 3.5% now, that would be 1.5 to 2 million additional jobs lost. But if there are 11.2 million job openings, as Taylor was pointing out, in theory, the Fed believes they could easily find new jobs, the people who are laid off. And so we look at what is going to happen tomorrow, and we want to see, and this is a little bit of a complicated chart, but let me explain it here. The number in yellow is the number of people who have lost their jobs. The blue is the number of people, number of job openings, and the white line there is labor force participation, and it has fallen dramatically since the pandemic began. That has to go the other direction to absorb people who are losing their jobs to get them hired. So far, it hasn't. So watch labor force participation tomorrow and watch the number of people who are unemployed. The Fed thinks that should rise. They don't think it will be a major problem because of the number of jobs out there, but none of that is happening yet, even though they've raised interest rates by 250 basis points this year.
And Mike, what do you make of all this stuff anecdotally that we see from companies cutting jobs, making all these proclamations about what's happening with the labor force, and then you see the data and we're looking at 300K tomorrow and claims this morning just look fantastic?
It does look, as Taylor was pointing out, like a lot of it is sectoral or company specific. We're going to have to see broader job cuts that have to do with demand falling before we really get an idea of whether it is a company issue or a major national issue.
Is it execution or economic weakness or a bit of both? And Snapchat may be a good example of some of that. Mike, looking forward to the ISM breakdown that you're going to deliver in about 8 or 9 minutes' time. Going to break down some of the price action for you right now, about 21 minutes into the session. We are lower by 0.75% on the S&P. Another day of losses on the cards here on the Nasdaq, down by more than 1 full percentage point with some of the sector price action. Here's Abby.
Well, John, it is pretty brutal because we are, of course, as you were just mentioning, down for a 5th day in a row and down more than 6% on the S&P 500 over those 5 days. So that bear market rally clearly has come to an end. And relative to sectors on the day, it is not surprisingly bearish, the theme of the morning. We have most sectors lower. Worst, energy down 2.8%. This, of course, as oil is back below $90 a barrel on demand concerns as China has shut down another major city. Materials also lower. Information technology down 1.4%. To the upside, you have communication services up about 0.6%, and then utilities and healthcare, both defensive sectors, higher. So those two being higher is not all that bullish. The stocks, though, that we've been talking about all day, chips, the stocks itself on the day down 3.5%. And this is extraordinary. Over the last 5 days, starting last Friday, John, down 13%. And of course, as we were talking about earlier, this has to do with NVIDIA and other companies struggling with both demand and those China shutdowns, restrictions relative to the U.S. and sales of some chips. One point I'd like to make, Citi is calling for that 25% decline. This index is already down 35%. That would be a 60% drop. And if I look back, the stocks in 2000 in that bear market down 84%. In the 2008 bear market, down 70%. That Citi call suggests that we might be doing something similar. So more bearish fodder for the day, John.
So many bears out there at the moment. Abby, thank you for that. Abby went through the last 5 days on the S&P 500. On the Nasdaq 100 over the last 5 days, down 7.5%. Off the back of this big move in the bond market. We add to it today, not at the front end though, at the long end, on a 10-year, after claims came out with a downside surprise. For me, if claims are delivering a downside surprise, I think that's the right kind of downside surprise. You want a decent jobs market. I know the Fed might be looking for something else. The 10-year was higher off the back of it by 4 basis points, breached through 325, right now 323. The dollar strength that we're seeing at the moment, just slicing and dicing up G10. Sterling 115.65, that currency pair negative 0.5%. You've got to go back to spring 2020 for these kind of levels. For the monthly performance we saw last month from sterling, the weakest month, going all the way back to 2016. From New York, your trading diary. Up next. Equities down. Here's the trading diary. ISM Manufacturing at the top of the hour. Fed speak from Bostic, 3:30 Eastern. You hear from the president at 8 p.m. Bit of data coming up tomorrow. The main event, it's payrolls. Payrolls Friday from New York. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
economic fallout is.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, September 1st. Here are the top market stories that we're following for you at this hour. Okay, it's September. We made it. Now what? A terrible August for the market leaves investors wondering what they can buy aside from the dollar. We break it down for you. And chip pain, who's going to gain? The U.S. restricts some NVIDIA chip sales to China. Seagate warns on computer hard drive demand. The sector battered after a tough month. And your last clue before jobs, we just got the latest read in the ISM just seconds ago. We're going to have instant analysis for you from Tim Fiore, chair of the ISM Manufacturing Business Survey. From New York, I'm Alex Steele alongside Tom McKenzie over in London. Guy Johnson is off today. Welcome to Bloomberg Markets. Tom, thanks for pulling triple duty. We really appreciate it. That ISM, though, just coming out.
Yeah, that is the redhead across the terminal right now, in line with the previous month. 52.8 for the month of August. Of course, ISM factory gauge coming in at 52.8. The estimates had been for 51.9, so it's a beat on the estimates, and it is in line with the month of July. Prices paid, the other component that's jumping out, 52.5 on prices paid. The previous month of July, 60, so significantly below what we saw versus July when it comes to prices paid, Alex.
Yeah, this is a really good report. New orders also coming in stronger, over 50 now, 51.3, and employment super strong, 54.2. Market reaction, sell bonds, equity still around their lows, and the dollar getting another bit higher. I wonder if this makes the Fed's job harder or easier. I just don't know. Let's get more insight then. Tim Fiore, the Institute for Supply Management's Manufacturing Business Survey Committee Chair, joins us. Tim, this is a really strong report. Can you take us through some of the details here?
Good morning. This is a wonderful report. I would call it a wonderful report. Coming in at pretty much 53. Last month, 53. The month before that, 53. I got to say, it feels like we're in a glide path here. We're not gaining elevation. We're not losing elevation. And after a prolonged period of over 60 expansion a year ago or so, this is no surprise. So, I mean, the sub-elements that make up the PMI really tell the story. And I think the fact that demand came back and started to expand a little bit is in line with the fact that lead times softened slightly too. And as you saw that prices number come down pretty dramatically, we're now at pretty much a supplier-buyer balance in terms of price structure. Production was a little bit weak, but I think the fact that employment gained to 54 and that eight out of 10 of our companies are still hiring, they're finding it easier to hire. The conditions to hire and keep people on the factory floor are improving is a real positive. And you know, the sentiment on demand was 5-1 positive versus last month 6-1. So everything looks good. I mean, supplier numbers. So if you go back 3 months ago, suppliers started to deliver a little bit better. And then 2 months ago, we saw prices come down pretty dramatically. And now this month, we're seeing employment improving and we're seeing lead time softening. It feels really good. I think the reason the production number didn't expand faster is because of the timing delay here. Employment's getting better. You know, we've got those suppliers delivering better. I'm expecting September to be a pretty good month.
Give us a sense, Tim, of what we're seeing in terms of inventories then. There have been some concern from some corporates, of course, flagging the build-up of inventories. Is that one kind of fly in the ointment at this point?
Well, I think I'm not sure I'm going to be overly concerned about it. We have a lot of supply managers now. I think about 18% of my headline comments were concerned about managing the total supply chain inventory, meaning they all have extended orders out there. They know at some point to be a day of reckoning. That's why we saw new orders weaken in the last couple of months. So they're really looking at a cash flow management situation, knowing that at some point there could be a more dramatic slowdown. And ultimately, they're going to be, stuck with that inventory because they can't convert and sell it. So there is additional heightened concern from a supply management standpoint for total supply chain inventory. There has been for quite some time. That's why you saw the new order rate come down over the last 3 or 4 months.
I just want to get a little bit more detail on the prices lower. Do we get a sense of if that's transitory or permanent? In that if inflation was transitory on the upside, why can't it be transitory on the downside? Or is it a result of, say, some demand destruction too?
Right. Well, I don't think we're in a supply-constrained expansion anymore. And I think the only big headwind, I believe, is really the energy markets at the end of the year here, when Europe has to make some decisions about Russian oil. Outside of that, I mean, we were on this glide path back in December, January, and then Russia invaded Ukraine, and it kind of flipped around because of food and energy. I think, the biggest headwind as far as prices is concerned at this point is what happens to the energy, petroleum barrel costs in the fall and the end part of the year. Outside of that, I think we're on our way back to something more normal. I think we're seeing that balance. I think we're really close to equilibrium. It's almost impossible to say when we're at there, and we probably will be at equilibrium for about 2 seconds, but this feels like we got a lot closer to it.
Tim, can you just unpack that a little bit more in terms of supply chains and where we are then in rebalancing? You're saying that we're close to, or it feels like we're in some kind of form of equilibrium, but then that caveat around whether it'll be short-lived. Do we have more details on that, and particularly the links when it comes to things like freight costs and then what's happening in China as well?
Right. So the comments clearly are indicating that transportation, including ocean freight, is flowing better than it had 3-4 months ago. No doubt about that. The headline comments around supply chain issues, prices, and deliveries declined significantly in August compared to July. All very positive. So in addition to that, our backlog gained again, which I feel comfortable about. I feel good about that. And our customer inventory number got worse, which is better, actually. It means that our panelist companies don't have as much inventory on their shelves as they need. So that's a real positive for the future. The only weak part of this report was new export orders, which is a little bit concerning. Really, it's Europe and China and what's going on in their economies. But that, out of this whole report, that's the only one that I've got a little bit of a question mark on, and it's too bad. But it's not unexpected.
And I got to say, the market is fascinating in what it's doing right now. You have a sell-off in the bond market, but it's the long end that continues to lead it. The 30-year is up by about 10 basis points. The dollar shoots higher, but equity is on the low. You have a really good economy right now. You have a solid number, and this is the reaction in the market. It's truly fascinating in what we're seeing in this also bear steepener here for the yield curve. I mean, I hate to take you outside your lane a bit, Tim, but it feels like good news becomes bad news for the market, and I'm wondering how you understand that. When you look at the data and then you look at reaction within the market, does that make any sense to you sitting where you sit talking to businesses?
Well, I can't rationalize what happens in the market.
Nobody
All
can.
I can do is be a spokesperson for the manufacturing community, and this is an absolutely good report. 3 straight months of 53. That means we're expanding at a rate of 5 or 8% for the last 3 months. Again, we're not we're not getting to 60,000 feet, but we're not coming crashing to the ground either. This is where we want it to be, supported by prices being close to 50. I mean, that's the appropriate tension. Supplier deliveries at a low 50 number, appropriate tension again. Still the opportunity on the customer inventory side. The right number for customer inventories in balance would probably be 47. We're still at 38. Backlog's growing. It's all good. We're able to hire again. Hiring conditions are improving. The quits rate seems to be coming down based on the comments. It's a great economic, and we're going into the strongest manufacturing period outside of March and April. I think September may even be stronger than March and April. So, as we close the year. So all good. This is really good.
Tim, 54.2, you've touched on this, employment, you've talked about the fact that the jobs situation has improved, they're filling some of those roles. Is that because they're increasing wages? How much of the wage growth is part of the play here? Or are they able to attract workers into these businesses without having to radically increase pay packages at this point?
Well, I'm sure there's a lot of wage growth increase. The people I speak with, the plans for merit increases and out of plan equity adjustments are much higher right now than they were 12 months ago. But I think you also have a combination, a little bit of uncertainty with workers wanting to quit in an environment that's a little bit uncertain. Everything they hear in the media is that there's going to be a recession. Okay, you say it long enough and people will believe it. Mm-hmm. And if that's the case, they're going to stick with their employer because of the seniority issue and the relationships with their bosses. So that can be part of it too. It's hard to put my finger on it, but I know the ability to hire is better. The amount of people quitting is less. The staffing, as you can see in the employment number, is better. I expect the production number now to jump back up in the month. I want supplier deliveries to stay where it is. Inventories staying as they are would be good too. So I think I'm hoping we're in a prolonged run here, at least 6 months of a 51 to 55 run.
Hey, Tim, it's always good to get your perspective. Really appreciate you catching up with us. We have to let you go. You know, you got to run to do the call here. Timothy Fiore, chair of the ISM Manufacturing Business Survey Committee. Just to reiterate there, I mean, a really, really solid number from the ISM, and the Bloomberg Dollar Index hitting a record high now as a result, surpassing the high that it saw back in July. ISM coming in 52.8. Prices paid also slowing a little bit. Employment super, super strong. All right, coming up, August, brutal month for investors. What can investors buy except for the dollar? Is there anything else? It is our question of the day, and we'll be talking to Charlie McElligott of Nomura Securities next. This is Bloomberg.
Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
The earnings risk is now upon us, right? We're cutting numbers, and we think the numbers are going to come down even further over the next 2 quarters. So the bottom line for us is PE multiple is wrong again, not because the Fed is going to be hawkish, but because the equity market is being too optimistic about the earnings outlook.
That was Morgan Stanley's Mike Wilson saying he expects more pain ahead for equity investors. This on the heels of an ugly month for returns across asset classes. For more on that story, let's bring in Bloomberg's Abigail Doolittle. Abigail, what really stood out for you then? We got the broad line picture from the Bloomberg write-up in terms of that cross-asset drop, the biggest drop since 1981 for the month of August. But the pain point, where is it most acute?
Well, you know, Tom, it's really interesting. What stands out to me the most about August is the fact that we came into August on the heels of this big rally. So there's this idea that it might not have been a bear market rally, but that the bottom had been found in June. And then here you see the month of August, not so much. So that's probably the biggest thing that stands out to me, the reversal that we saw mid mid-month that took the S&P 500 down about 5%. Its worst month since June. Of course, the index down sharply on the year. Interestingly, commodities about flat to up a little bit. You had oil, gold, silver down, but on the other hand, you had natural gas up 11%. You had corn up about 8%, wheat higher. But you were talking about that cross-asset move. Take a look at this 2-year yield. It's simply stunning, up more than 0.5%, up 63 basis points in the month. This tells you the degree of the dislocation on the part of bond traders after that July meeting when they were expecting some sort of a pivot into the Jackson Hole Summit or Symposium, when Fed Chair Jay Powell made it very clear that the Fed is going to stay hawkish. That's really what's producing this board, and also, of course, has supported the dollar higher, that Bloomberg Dollar Index on the month. That's a huge move, up 3.3% for a currency to move that much higher. And that higher dollar, of course, those higher rates makes everything else more expensive. So that's why we see the losses. Now, if we dig into it from a sector perspective, we're going to see something interesting because there was only 2 sectors higher. This is the case on the year too, energy and utilities. Energy is up 2.2%. It's not a defensive sector, but it is considered to be deep value still, even after the huge run. Utilities, that is a true defensive sector. Very unusual with rates rising that you have utilities going up. So that's defensive sectors higher, basically, or value sectors higher. On the bottom, though, take a look at technology, healthcare, real estate. On the year, you have many sectors down more than 20%, including those mega cap sectors. And again, on the year, only 2 sectors higher. So August very much a mirror of the year. And then finally, this is so interesting. Dan Curtis, our markets producer and team manager, he made this, and it's really so interesting because, of course, September is seasonally the worst month for stocks. But if you go into September with a gain, it tends to be an okay September, up 0.3%. If you go into September with a loss, not so much. We right now have a loss for stocks. If you go into September with a loss, as we are now, the average decline is down 2.5%, but it could even be more.
Yeah, if anything, we're looking at the market today and we're seeing some steep losses again. The S&P off by a full percentage point, NASDAQ 100 off by 1.5. Abigail, thanks a lot. We really appreciate it. And this brings us to the question of the day. What can you buy right now except for the dollar, with the Bloomberg Dollar Index setting a record high on that very strong ISM manufacturing number? Well, Charlie McElligott, Nomura Securities Managing Director for Cross Asset Strategy, whose job I'm sure has been very difficult over the last month or so. Hey, well, Charlie, thanks for joining us. What do you buy if you're not going to buy the dollar?
Good to see you, Alex. So look, what you've seen over these past 2 weeks, certainly with regards to this big financial conditions tightening impulse, has basically been a throwback to all of the trades that dictated performance over the first 6 months of the year, in the first half, when we were under that same regime, right? We were worried about the Fed playing catch up. Obviously, this miss on the transitory inflation, forcing them to be behind the curve. So the stuff that worked back then is the same stuff that's working right now and has driven this reversal and has driven this performance. It's long dollar, as you said, and then it's also, too, short fixed income, short bonds, short rates, and then also as well the short equities trade. And the thematic stuff that is working, certainly within the equity space, is also too the stuff that worked in the first 6 months. And that's, from a market neutral type perspective, that's, long low risk, short high beta, right? That's long value, short expensive. And that's why you've seen this, really impulsive move, particularly lower in the stuff that requires lower yields to justify expensive valuations, i.e. secular growth, all that stuff that was kind of the story for the past decade. It's continuing to lead to the downside now because the market is frankly assessing this restrictive for longer framework from the Fed and still seeing hot jobs data, i.e. initial jobless claims again this morning, that are just going to make the Fed, put them in a really awkward position where they're going to have to keep leaning in, which perversely then creates a situation where we're probably more likely to crash land next year.
So, Charlie, where are we in that reassessment then? As we look ahead to growing expectations, you may get 75 basis points from the Fed in later this month. How much more downside potentially is there? Is 75 basis points another catalyst for a further leg down?
I think 75. I mean, it's certainly tilted that way right now, just through implied pricing, and same for the ECB, which also too played a big part in this, market shock that we've seen the past 2 weeks, just with regards to their own energy crisis and the impact that you're seeing in EGBs bleeding out into global fixed income, simply on the fact that this wave of tightening, which is creating this, real yield move higher, which is a pure slamming of the brakes on the economy, on the cost of credit, on the cost of capital, as well as the dollar stronger, which is kind of like a margin call on the rest of the world. It's really hammering this point that they're going to have to run tighter for longer, which then, again, perversely creates this move into the back part of next year that's telling you they're going to have to ease big on the way out of this thing. But right now, the thing that's really upsetting people, particularly into tomorrow's non-farm payroll, is the fact that labor just won't back off. When you have inflation where it is currently running, on top of, and particularly led by sticky services and things like that, but on top of employment data staying so strong and wage growth staying where it is at effectively record highs, that increases the likelihood of an accident, and frankly, it decreases the likelihood of a soft landing.
Well, this is exactly what we're seeing play out in the market, right? King dollar, sell equities, you sell rates, yields pushing higher. That is definitely 100% playing out. But Charlie, what do you do? Like, if you're a cross-asset person, how do you play this uncertainty, particularly if you look at a VIX that's in pretty steep backwardation? So volatility today is much higher than tomorrow or later on down the road, which is normally unusual. What's a playbook that's going to work for you?
Yeah, I think right now a lot of people from like the vol perspective, they're kind of short here. They're short vol here to fund long vol positions further out. That's kind of similar to what you're seeing with, fixed income curve trades, where you've had the bear flattener on, that idea of tighter, more restrictive for longer, or even adding in more hikes. So terminal rate is inching higher still and pushing out a little further in implieds. But then too, seeing forward bull steepeners, which will then, benefit as we hit that hard landing and the Fed does ultimately have to pivot on jobs. As I said earlier, with regards to the equity stuff, it's all about things that work in a, kind of a rising rate environment or a risk-off type of environment. So the longs are, as you said, it's in stuff like Utes and staples, as opposed to the discretionary stuff, and specifically as opposed to high beta or high expense, high valuation stuff, which continues to be the first place that equities players look to kind of lean into downside. The ARCs of the world and those highly speculative types of plays, the big extreme valuation type of software companies. You're seeing that right now. That's the stuff that's leading lower, just because this yield move isn't over. And again, the only thing that I'm talking about right now is the move in real yields, which are nominal yields inclusive of inflation, which are just screaming tighter, and it's as I said, it's slamming the brakes on the real economy and the cost of capital for corporations as we move forward, and that's a negative for risk assets.
Yeah, and on that point, Charlie, we're looking at the 30-year stateside now, 339. That's a move higher in yields, 9 basis points just in terms of nominal yields there at the long end. Charlie McElliott, Nomura Securities Managing Director for Cross Asset Strategy, thank you for those insights. Still ahead, frustrated by cancelled flights and airlines that do not seem to care. American carriers now seem to be bowing to the pressure. Details are next. This is Bloomberg.
Amanda Gordon. It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Problems for Microsoft's planned $69 billion purchase of Activision Blizzard. The deal will be spent for an in-depth review unless the company offers remedies to address the UK's watchdog's competition concerns. Regulators are concerned the combination will lead to fewer choices in the gaming sector. Microsoft says it's ready to work with them on their objections. Add Jefferies to the list of financial firms that want their employees back in the office. Jefferies is asking staffers to come back on a more consistent basis to work through an investment banking backlog. According to a memo, the firm has no issue when employees need to work from home from time to time, but it wants senior bankers to be coming in to motivate their junior counterparts. And the largest U.S. airlines are now making more explicit pledges on how they'll treat passengers when they cancel or significantly delay flights. That comes after pressure from the U.S. government. The Department of Transportation has unveiled a website publicizing airlines' plans. The carriers are promising meals and hotel rooms in some cases for disruptions. And that is your Business Flash. Alex?
All right, thanks, Ritika. In no way, Tom, do I think that's actually going to happen. I guarantee you they'll be like, your flight's delayed because of the weather, and you'll look outside and it'll be completely sunny, and you won't get your hotel room, and you won't get free meals. I'm just saying.
Do you know, I didn't take a flight this summer, but it was chaos for friends and family who did. And they didn't always get that hotel room or that food, sometimes stuck in airports for hours. So we had a similar problem here as well, Alex. We'll see what happens stateside, of course.
No way. I'm going on one trip at the end of October, and the flight's been rescheduled 5 times already. Just going to put that out there. Yeah. All right, coming up, Friday's jobs report, obviously crucial for the Fed, particularly at that really strong ISM report. We're going to break that down next. This is Bloomberg.